Understanding Keynesian Economics, a comprehensive overview. Keynesian economics is a foundational macroeconomic theory that addresses total spending in an economy and its effects on output, employment, and inflation. Developed by British economist John Maynard Keynes in the 1930s, this theory emerged as a critical response to the economic challenges posed by the Great Depression, offering insights that shaped modern economic policies. The core principles of Keynesian economics. At the heart of Keynesian economics is the belief that government intervention can stabilize the economy. Keynes argued that inadequate aggregate demand leads to prolonged recessions, high unemployment, and deflation, a stance that significantly diverged from classical economics, which emphasized self-correcting market mechanisms. Keynesian economics posits several key assertions. Government intervention. Active government policy is essential to manage aggregate demand and prevent economic recessions. Stimulating demand. During economic downturns, increased government expenditures and tax reductions can stimulate demand, thereby revitalizing the economy. Full employment and price stability. With appropriate intervention, Keynesians argue that a government can achieve full employment and maintain stable prices. Historical context. Keynes and the Great Depression. John Maynard Keynes published his seminal work, The General Theory of Employment, Interest, and Money, in 1936 amid the devastation of the Great Depression. He critiqued the classical economic theories, which suggested that free market mechanisms would self-correct through individual actions. In Keynes's view, the Great Depression revealed the limitations of classical economics. Factors such as business pessimism and sluggish aggregate demand led to sustained economic decline, contradicting classical assumptions that market forces would restore equilibrium. He advocated for countercyclical fiscal policies, where the government should engage in deficit spending during economic downturns to boost overall demand. Disconnection from classical economics. Classical economists believed that during recessions, lower wages would incentivize businesses to invest, thereby correcting unemployment and stimulating growth. Keynes countered this notion, arguing that reduced wages could deter capital investment, as businesses would be hesitant to expand under unfavorable market conditions. This perspective illustrated a fundamental break from classical economic thought, highlighting the importance of demand-side factors in the economy. The mechanisms of Keynesian theory. Fiscal policy and the multiplier effect. One of the cornerstone concepts of Keynesian economics is the multiplier effect, introduced early on by Keynes's associate Richard Kahn. This concept states that an initial increase in government spending leads to subsequent rounds of spending, amplifying the overall impact on the economy. For instance, when the government invests in infrastructure, it creates jobs, leading to increased income for workers, who then spend more, further stimulating business activity. The role of monetary policy. In addition to fiscal policy, Keynesian economics acknowledges the significance of monetary policy in managing economic fluctuations. During periods of economic susceptibility, central banks may lower interest rates to encourage borrowing and investment. However, Keynesians caution that overly low interest rates can create a liquidity trap, where consumers may choose to hold on to cash rather than spend or invest, countering the intended efforts of monetary policy. Criticism of Keynesian economics. Despite its profound influence, Keynesian economics has faced criticism from various economic schools of thought. Critics, particularly from the monetarist school led by Milton Friedman, argue against the reliance on government intervention. They contend that market forces can typically self-correct and that government involvements distort supply and demand relationships. Critics also challenge Keynes's assertion that increased government spending effectively stimulates the economy, claiming it may lead to unsustainable debt levels and crowding out private investment. The debate continues, with economists seeking the optimal balance between fiscal stimulus and market-driven adjustments. Keynesian economics in modern context. Tenets of Keynesian economics resurfaced during the 2007 to 2008 financial crisis, when governments worldwide implemented stimulus packages to mitigate economic collapse. In the United States, the American Recovery and Reinvestment Act of 2009 exemplified Keynesian principles, channeling $831 billion into the economy through tax cuts and government spending aimed at reviving demand and job creation. Conclusion: Keynesian economics remains a pivotal framework in contemporary economics, influencing not only academic discourse but also practical policy making. John Maynard Keynes's ideas about the necessity of government intervention in stabilizing the economy have shaped our understanding of macroeconomic dynamics, especially during periods of uncertainty. As the world confronts new economic challenges, Keynesian principles continue to serve as a crucial tool for policymakers aiming to stimulate growth and foster economic stability. Further reading. For those interested in delving deeper into Keynesian economics, consider the following resources. The General Theory of Employment, Interest, and Money by John Maynard Keynes. Keynes and the Classics, a study of the classical theory of employment by A.P. Thowall. Articles on the contrasting views of Keynesian economics and monetarism, particularly those discussing the contributions of Milton Friedman. Understanding these principles not only enriches one's perspective on economic issues but also equips individuals to engage thoughtfully in discussions about fiscal and monetary policies.